Remember, rich people buy munis, poor people buy corporates, and wimps buy treasuries. There are three types of bonds you're going to see on the SIE: corporate, municipal, and treasury. You got to know the risk, the return, and how the U.S. government taxes the hell out of them or doesn't. So start with corporate bonds. They're issued by companies to raise money. Risk, highest of the three, usually based on credit ratings. Companies go bankrupt, shit happens. The reward, they pay a higher interest to compensate for that risk and the taxes. The taxes, it's fully taxable, federal, state, and local, you pay all of it. Remember, when we're talking about the taxes, it's about the interest income, not the trading. Whenever you're trading a bond, buying and selling, you're paying capital gains. But I'm talking about the interest that they pay you every 6 months. When I talk about taxes, that's what I'm talking about. Don't forget, in the corporate bond, we have secured, like mortgage bonds, equipment bonds, collateral bonds. They're backed by a product. So if the company defaults, they sell the product or whatever it is to pay the shareholders, bondholders. The second one is unsecured, known as debentures. They're promised by the I promise to pay. There's literally a promise to pay. That's it. If they default, you just get in line and hope they have the money to pay you. You're called a creditor when you own a bond. Municipal bonds, munis, issued by state and local governments. There's two main types: GO, general obligation, backed by taxing power. They're usually for things that are free to use. Then we have revenue bonds, backed by income from a project, tolls, stadiums, stuff like that. Then we have muni notes, short-term munis usually used for temporary cash flow. Think like a year or less. We call them RANs or bands, revenue anticipation notes, bond anticipation notes. Now, munis are generally safer than corporates and stuff, but you can't go by that because it's still always about the credit rating. If I have a double A corporate, that's safer than a single A muni. But I always think munis are a little safer. You can't really push on that, but it's just an idea. But the thing is, munis, the interest is tax-free on the federal and most likely on the state also if you buy in your own state. Because there's no taxes, that's better for the investor. Your yields will be lower. So a couple things. Munis have a lower yield usually because it's tax-free, and they're not very liquid because they're munis. They're boring. They have a lower yield, you get the tax break, and they're good for rich people. Again, rich people buy munis, poor people buy corporates, and wimps buy what's coming up next: Treasury. Treasury debt is issued by the U.S. government. There's a couple types. T-bills, short-term, 1 year or less, no interest. You get the interest at the end. It's sold at a discount. T-notes are 2 to 10. T-bonds are 10 to 30 years, and they pay a coupon every 6 months. TIPS, Treasury inflation protection securities. Principal adjusts with inflation. The interest is paid on the adjusted principal. So when inflation goes up, the par value goes up, so you make more money every 6 months based on inflation. It doesn't beat inflation, it matches it. Then we have strips, not where you're going tonight after you pass. These are long-term zero coupons. There's no interest each year. It's just at the end, you buy it at a discount. This is great for target-based investing, okay? A lot of times when you hear the strip, it's mostly about going to be for college savings. So the strips you buy at a deep discount is like $200, and then at maturity, it's worth $1,000. You get a check for $1,000. So, but if you're in the high tax bracket, maybe not a good idea because the IRS goes, hey, you're paying $200 now, you're getting $1,000 in 20 years. We're going to tax you on a little bit each year. That's called accretion. That's no good. So if you're in the lower end of the income stratosphere, that's good because you don't worry about the taxes so much. Now, the thing about the interest on treasuries, couple things. One, it's backed by the government, so there's no default risk. So the coupons are lower because there's no default risk. They will pay. The other one is it's taxable on the federal level, but not on the state level. You are going to get lower yields because you're buying the safety. Again, no state local tax, but you still pay federal. So I'm thinking safety first, lower returns, and it's tax friendly in a lot of states. The way I remember the treasuries is bills, notes, bonds, tips, and strips. That's short to long. Bills, notes, bonds, tips, and strips. Bills are a year. Notes are 2 to 10. Bonds are 30. Tips are inflation protected up to 30. Strips are zero coupons up to 30. So don't make it harder than it is. Who issues it? What's the risk? How much to make? And how much gets taxed? That's a lot of it for the SIE exam. But remember, rich people buy munis, poor people buy corporates, and the wimps buy treasuries. Let's fucking go, baby.